Ladies and gentlemen, good day and welcome to Technoplast Q2FY26 earnings conference call hosted by Motilal Oswal Financial Services. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. I now hand the conference over to Mr. Ashish Poddar from Motilal Oswal Institutional Equities. Thank you, and over to you, sir.
Yeah, thank you, Sam. Good afternoon, everyone, for joining this conference call of Technoplast fourth year Q2FY26 results. From the management, we have Mr. Bharat Kumar Vagega, the Managing Director, Mr. Raghupati Thiagarajan, the Whole-Time Director, Mr. Sandeep Modi, Senior Vice President, Accounts and Corporate Planning, and Mr. Hemant Soni, Vice President, Legal and Corporate Affairs. I hand over the call to Bharat sir for his opening remarks, post which we can open the floor for Q&A session. Over to you, sir.
Yeah. Gentlemen, good afternoon, our esteemed investors, respected colleagues, and thank you to team of the Motilal and Ashish Poddar who is organizing this call. For the kind introduction, it is both an honor and pleasure to address you today as we present our financial and operational performance for Q2 and half-year H1 FY26, along with our outlook for the remainder of the fiscal year. Our momentum remained strong in H1 FY26 with 14% volume growth and 10% rise in the revenue growth. The gap of 4% is on account of the reduction of the raw material prices. Despite this, we delivered solid operational performance, balancing volume strength with the effective revenue management. The CNG composite cascade segment stood out with the robust 22% growth, materially boosting our overall performance with a strong contribution from other composite products. Composite volumes increased 18.3%. Profit after tax rose 18% year-on-year, underscoring our focus on capacity utilization and disciplined financial management, particularly around the finance cost. We are encouraged by the sustained demand of Type 4 composite cylinder, reflected in the healthy order book of around 195 crores. This momentum is further supported by using interest in our value-added product, in our value-added offering through our composite products, which includes LPG, CNG, oxygen, and other composite products for automotive sectors. Our industrial packaging division also continued to perform steady with a confirmed order pipeline of approximately rupees 450 crores for the current calendar year across both domestic and international market. Our results reaffirm the resilience of our diversified business model and the strong platform we have built for the future. Moving forward, we will continue to pursue new opportunities and accelerate our transition towards a sustainable, environmentally responsible growth that delivers long-term value for the every stakeholders. Now let's take a closer look at the key highlights of our financial performance presented in the result. The key figures are during the Q2 FY26 compared to Q2 FY25. Our result are net sales stood at 1,512 crores as against 1,372 crores. EBITDA 224 crores as against 197 crores. Profit after tax 115 crores as against 98 crores. This is compared with the corresponding quarter previous year. Sales grew by 10%, which includes India 9%, overseas 13%. Volume increased by 14%, India 13%, overseas 16%. EBITDA increased by 14% and PAT increased by 17%. During the H1 FY26, on a consolidated basis, net sales stood at 2,866 crores as against 2,602 crores last year. EBITDA 420 crores as against 372 crores last year. Profit after tax 211 crores as against 178 crores last year. In terms of the percentage, net sales increased by 10.1%, India 8.5%, overseas 13.2%. Volume increased by 14%, India 12.2%, overseas 16.4%. EBITDA increased by 13%, PAT increased by 18%. In percentage terms, you must find that EBITDA is increased as the volume growth is increasing. It's almost as the volume increase, EBITDA further is going to be increased. In H1 FY21, EBITDA margin 14.6% as against 14.3%, increase of 30 basis points. That's in every my conference call I said, you will find yearly improvement of 20 to 30 basis points in the EBITDA margin. Now, share of the business, established product versus value-added product. Value-added product grew 17% in HY FY26 as compared to HY FY26, while established product grew by 8%. The share of the value-added product is 28% of the total sales in H1 FY26 as against 27%. This percentage year on year is going to be increased and that will help us in the improvement in the other as far as margins, PAT, EBITDA and ROC. Now, share of the India and overseas business in HY26 was 64.36% as against 65.35%. EBITDA margin in India and overseas, India is 14.8%, overseas is 14.3% respectively. Net cash from operative activity H1 FY stood to 226 crores. Total debt net of the cash H1 FY26 reduced to 56.4 crores. And that company focus will continue for reduction in the debt. Total capex incurred in H1 FY26 was 170 crore, which includes 42 crores towards the regular maintenance, capacity expansion, brownfield for the established product, and rupees 75 crores towards the value-added product, mainly called IBC and composite product expansion, which is on the way only. I would like to now draw your attention to a couple of the interesting developments which we have seen in the quarter and which we have seen till now, especially after the QIP. Now, as far as bonus share is concerned, the board allotted 22.69 crore lakhs fully paid up equity shares of face value of 1 rupees each on 24 September. That's reflected in every of my investors. And that have been issued out of the premium available with the company. Then, recent development which we have seen and closed on the 11th of this November, in the November month, that company successfully completed 800 crores QIP, issuing 397.77 lakhs equity shares at the price of 201.12 per shares, which is face value of 1, including premium of 200.12, pursuant to allotment on 11th November 25. The paid up share capital increased from 45.38 crores to 49.36 crores. List of the allotee who have been allotted more than 5% of the equity share offered pursuant to qualified institution placement. The major names I will just tell you: the 3P India, which is managed by the Prashant Jain, who was earlier managing HDFC Fund. Then the international company like Aberdeen Group, Axis Mutual Fund, Edelweiss Mutual Fund, and Edelweiss Life. These are some big names who bought this equity. Resulting, you will see the equity which was there on the 30th September and equity which was on 11th November after the allotment of the QIP. Promoters and promoter group equity is reduced 47.46% from 51.62, resulting 4.16% dilution. There is no any offer for sale from the promoter. All the funds have gone in the company's account only. DII mutual funds is percentage terms from the total equity after the bonus, after the QIP, increased to 16.63% as against 13.26%. So in nutshell, I can say the domestic mutual fund investment is increased by 3.37%.
I believe we have lost the line for the management. Please continue to stay on hold. A request to participants to continue to stay on hold while we connect the management line. A request to participants to continue to stay connected while we connect the management. Ladies and gentlemen, we have the line for the management connected. Please go ahead, sir.
Yeah. Dear friends, sorry for interruption because some connectivity issue was there, technical problem. But again, I am continuing from the financial, what I have explained to you, and I am continuing from now the highlights, which is especially started from the bonus shares. Company has issued the bonus shares of 22.69 crores, which is 1:1, and on 24th September, so which is capitalized in 22.69 crores, which is from the security premium account. Now, after that, in the month of November, company launched QIP, and company successfully completed 800 crores QIP, issuing 397.77 crores. I am pleased to tell you, company has received a bid for 931 crore, but accepted, considering the long-term investor, the value of rupees 800 crores, and share issue price is 201.12, which is after 5% discount from the NSE advice, NSE regulations, the 211.70 price was there as per the NSE formula. Pursuant to this allotment, equity shares increased from 45.38 crore to 49.36 crore. List of the allotee who is allotted more than 5% equity share offered are mainly 3P, which is managed by the Prashant Jain, who was earlier managing largest fund in India, that was HDFC Fund. Then Aberdeen Group, this is a new entry from the international, is a very large fund, and Axis Mutual Fund, Edelweiss Mutual Fund, and Edelweiss Life. And I am great to tell you now, the domestic institution and foreign institution equity have increased. Like promoter and promoters group, because of this QIP issue, reduced to 47.46% from 51.62%. There is a reduction of 4.16%. I would like to clarify you, company has not, promoter have not offered any offer for sale. It is entire subscription, entire paid equity, 800 crores have been gone in the company account only. Domestic institution mutual fund increased to 16.60% against 13.26%. There is an increase of 3.37%. FIIs, which includes NT assets and Aberdeen, 11.05% as against 8.42%. There is an increase of 2.63%. Public equity reduced by 1.84%. Currently, as of 11th November, is 24.86% as against 26.70%. And I am glad to tell you, today, the number of the shareholders in our company, investors, are around 150,000 numbers. As again, I remember the March 20, it was around 25,000 shareholders. Now, sale of the non-core assets, one point of time, 2 years back, company management decided to sell off, realize the value of 125 crores value of the assets, which is not in use, including the small project, land building, etc., machineries, is now reduced to 41 crores. And as of 30th September, and time to 8 months' time. ROC improvement is definitely year-on-year improvement is there, because 3 years back, company management has given the guideline ROC 12 to 14, then 14 to 16, 16 to 18. So 18 is already achieved by March 2025, and now, and thereafter 2% increase, minimum to investment of the company, and consolidated of the production products and the manufacturing units, which is the continuous process, and is going to be next 12 months' time. And considering the logistic cost comparison. International Center Automotive Technology is a government authorized agency approved e-rickshaw batteries which is one of the subsidiary company, Power Mill Batteries Limited, is has a very good potential in the period ahead. Market size based on the current rickshaw which are in the market is around 6,400 crore, but very small entry company has taken, adapting business of at least 20. After getting this report in annual business, we can get around 40 to 50 crores. But currently, we have considered the only secondary market supply, and the OEM we will approach when after the expansion we will complete, which is going to be complete by March 2025 or 26. Another thing, green energy conversion of the electricity unit consumed to the solar power, which process is on. I had mentioned in all the calls and meetings, currently based on the March 25 is around 15 crores units, which currently buying from the government nominated company, like in Maharashtra Electricity Board, Gujarat Electricity Board, but else some of the states have cleared, we can buy by signing a purchase power agreement. So we did for our consumption of 4.5 crores units from the this certain governments who has agreed, and we have signed the agreement. So this benefit will come from next year. In terms of the value, I can say 4.5 crore units. If you multiply by 2 rupees 50 paisa units, then 10 to 12 crores EBITDA will increase by way of this 4.5 crore. But certainly, if at all entire government, all the states cleared this policy of the purchase power through solar, then my requirement is 12 crores units, so we can get a substantial benefit of maybe around 30 crores for this power itself. Then another sustainable, new sustainability focused subsidiary company, Recycle Material and company has formed one time Ecotech Private Limited company, which is 100% subsidiary of our listed company, Time Technoplast Limited, and overall plan